What is a business cycle? Business cycles are a type of fluctuation found in the aggregate economic activity of a nation. A cycle that consists of expansions occurring at about the same time in many economic activities, followed by similarly general contractions, recessions. This sequence of changes is recurrent but not periodic. The business cycle is an example of an economic cycle. Understanding the business cycle. In essence, business cycles are marked by the alternation of the phases of expansion and contraction in aggregate economic activity, and the co-movement among economic variables in each phase of the cycle. Aggregate economic activity is represented by not only real, i.e., inflation-adjusted, GDP, a measure of aggregate output, but also the aggregate measures of industrial production, employment, income, and sales, which are the key coincident economic indicators used for the official determination of U.S. business cycle peak and trough dates. A popular misconception is that a recession is defined simply as 2 consecutive quarters of decline in real GDP. Notably, the 1960-61 and 2001 recessions did not include 2 successive quarterly declines in real GDP. A recession is actually a specific sort of vicious cycle, with cascading declines in output, employment, income, and sales that feed back into a further drop in output, spreading rapidly from industry to industry and region to region. This domino effect is key to the diffusion of recessionary weakness across the economy, driving the co-movement among these coincident economic indicators and the persistence of the recession. On the flip side, a business cycle recovery begins when that recessionary vicious cycle reverses and becomes a virtuous cycle, with rising output triggering job gains, rising incomes, and increasing sales that feed back into a further rise in output. The recovery can persist and result in a sustained economic expansion only if it becomes self-feeding, which is ensured by this domino effect driving the diffusion of the revival across the economy. Of course, the stock market is not the economy. Therefore, the business cycle should not be confused with market cycles, which are measured using broad stock price indices. Measuring and dating business cycles. The severity of a recession is measured by the 3 Ds: depth, diffusion, and duration. A recession's depth is determined by the magnitude of the peak to trough decline in the broad measures of output, employment, income, and sales. Its diffusion is measured by the extent of its spread across economic activities, industries, and geographical regions. Its duration is determined by the time interval between the peak and the trough. In analogous fashion, the strength of an expansion is determined by how pronounced, pervasive, and persistent it turns out to be. These 3 Ps correspond to the 3 Ds of recession. An expansion begins at the trough, or bottom, of a business cycle and continues until the next peak, while a recession starts at that peak and continues until the following trough. The National Bureau of Economic Research, NBER, determines the business cycle chronology, the start and end dates of recessions and expansions for the United States. Accordingly, its Business Cycle Dating Committee considers a recession to be a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. U.S. expansions have typically lasted longer than U.S. recessions. From 1854 to 1899, they were almost equal in length, with recessions lasting 24 months and expansions lasting 27 months, on average. The average recession duration then fell to 18 months in the 1900 to 1945 period and to 11 months in the post-World War II period. Meanwhile, the average duration of expansions increased progressively, from 27 months in 1854 to 1899, to 32 months in 1900 to 1945, to 45 months in 1945 to 1982, and to 103 months in the 1982 to 2009 period. The depth of recessions has changed over time. They were typically very deep in the pre-World War II, World War II period, going back to the 19th century. With cyclical volatility drastically downshifting after World War II, the depth of recessions decreased greatly. From the mid-1980s to the eve of the 2007-09 Great Recession, a period sometimes dubbed the Great Moderation, there was a further reduction in cyclical volatility. Also, since about the start of the Great Moderation, the average longevity of expansions appears to have roughly doubled. Stock prices and the business cycle. In the post-World War II period, the biggest stock price downturns usually, but not always, occurred around business cycle downturns, i.e., recessions. Exceptions include the crash of 1987, which was part of a 35% plus plunge in the S&P 500 that year, its 23% plus pullback in 1966, and its 28% plus drop in the first half of 1962. However, each of those major stock price declines occurred during GRC downturns. Indeed, while stock prices generally see major downturns around business cycle recessions and upturns around business cycle recoveries, a better one-to-one relationship existed between stock price downturns and GRC downturns, and between stock price upturns and GRC upturns, in the post-World War II period, in the decades leading up to the Great Recession. Following the Great Recession of 2007-09, while full-fledged stock price downturns, featuring over 20% declines in the major averages, did not occur until the 2020 COVID-19 pandemic, smaller 10%-20% corrections clustered around the four intervening GRC downturns, from May 2010 to May 2011, March 2012 to January 2013, March to August 2014, and April 2014 to May 2016. The 20% plunge in the S&P 500 in late 2018 also occurred within the fifth GRC downturn that began in April 2017 and culminated in the 2020 recession. In essence, the prospect of recession usually, but not always, brings about a major stock price downturn. But the prospect of an economic slowdown, and specifically, a GRC downturn, can also trigger smaller corrections and, on occasion, much larger downdrafts in stock prices. For investors, therefore, it is vital to be on the lookout for not only business cycle recessions, but also the economic slowdowns designated as GRC downturns. Those interested in learning more about business cycles, stock prices, and other financial concepts may want to consider enrolling in one of the best investing courses currently available. What are the stages of the business cycle? In general, the business cycle consists of four distinct phases: expansion, peak, contraction, and trough.